Hi, welcome back to my channel. My name is Abhishek Bal. Today we're going to discuss about the mortality table and the different application of mortality table. Most notably, how the calculation of premium payment vis-a-vis the claims payment happen in case of life insurance. We're going to discuss that in length. However, one must understand that the application of mortality is not only restricted to calculating the premium or the claims outflow of a life insurance company. It's also used in enumerating the annuity and how an annuity product could be priced, as well as that of the pension plans. So without much ado, let's first understand a few basic things about insurance, and that's required in order to glean through it. So to begin with, insurance is basically pooling of risk and reward. All that it means is that if 100 people contribute to a particular fund, it is expected that only 2 people out of that will claim. What we mean by claim is basically a default against the risk for which people actually have paid to cover that risk. We call a couple of things out here. So the price or the money that is being paid to cover that risk is called the premium. And as it happens, the premium is always supposed to be paid beforehand. The risk is underwritten. And in case of an eventuality for which that risk is being covered, the payout by the insurance company is called the claims payout. Now, to what extent the claims can be paid out, that is determined by something called as sum insured or sum assured. So, in case of a life insurance policy, we call it sum assured. So, all that it means is that, let's say you purchase a life insurance policy. You are a healthy 30-year-old male and you decided to purchase this policy for the next 30 odd years. All that it means is that by the time you are 60, a couple of things could happen which is complementary to each other. Either you live up to 60 or there is an untimely demise of yours. So either of in these cases, one thing which is certain is that you would be made a payout if there has been a death between 30th year and the 60th year. Now, who is going to get the payment out of that? The policyholder's kith and kin, who is also known as the nominee or the beneficiary of the insurance policy. He or she will be entitled to the claims payout. What happens if you don't die? Well, if you don't die, depending upon the type of policy that you have purchased, either it's a whole life or an ordinary life insurance policy, which means that you would be guaranteed of a certain payout upon completion of the policy terms, regardless of whether you live or you die interim. So if you die interim, of course, to the extent of the sum assured, the amount will be paid to your policy beneficiary. But if you do not die, in case of a whole life or an ordinary life insurance policy, you could encash or redeem that policy at the end of its maturity. So the 30-year period is called the policy year, and at the end of the policy year, your sum or your policy is said to be matured, at which point, if you're alive, then you will be able to redeem or encash your proceeds. Okay, now these proceeds will have two values in them, two components to them. One is, of course, the sum assured, which we talk about, which we talked about, and the second is basically the accumulation value, which is also called as the bonus. So these put together is what you're going to get as part of your ordinary life insurance policy at the end of your policy term. On the other hand, the term life insurance policy is somewhat different. The term life insurance policy is a contingency based policy. So all that it means is, suppose you have taken a policy when you were 30-year-old and your policy is supposed to continue up until you are 50-year-old. So every year you will be paying the insurance company the cost for undertaking the risk of your death, which is known as the premium. So every year you will be paying a certain premium, and up until 50th year you will be paying this premium. However, if there is an eventuality at any time interim, let's say on the 42nd year, the insurance company, based upon the sum assured, will pay the entire amount of sum assured to the beneficiary of the particular policy. Okay, in this case also one must remember that at the expiry of the policy, If there is no death, then entire premium is being kept at the insurance company's end, and the policyholder will get nothing out of it. But if there is a death, interim death, that is between 30th and 50th year, the policy nominee or the policy beneficiary will get money up until to the extent of the sum assured itself. But obvious that this sum assured is going to be somewhat lesser than the sum assured and the accumulation value that is being offered by the ordinary life policy, because it only pays up to the sum assured. Hence, the premium is also proportionately less than that of an ordinary life policy. The other terminologies that you need to understand is there are a couple of variations to this particular policy. One is called the variable life insurance policy, wherein the policyholder is allowed to decide the investment vehicle that the insurance company should choose for that particular policy. For instance, in case of an ordinary or a whole life insurance policy, since your premium is being collected by the insurance company every year, so that premium is being invested into market investment vehicles. Now, depending upon your risk appetite, the insurance company will place certain choices in front of you in terms of different fund, F1, F2, F3, etc. And within those choices, you will be exercised that which particular fund that you would want your uh, premium to be invested into. You could also make a balancer fund, which means that you need not park your 100% of the premium in any one particular fund, but you may spread it over 2 to 3 different funds. So this flexibility is being retained at the policy holders a discretion provided by the insurance company itself. Because of this variability, this is called a variable life insurance policy. On the other hand, the universal life insurance policy enables the policyholder to reduce the premium should he or she so decide that the policy in effect is a little bit costly. So he or she may decide to underinsure and pay proportionately less premium. That is being also allowed, and hence it is called the universal life insurance. The combination of these two is called as the variable in universal life insurance policy as well. Lapsing, on the other hand, is wherein the policyholder has actually failed to make the necessary payment to the insurance company at any given particular year within the policy duration. So, for example, let's say he purchases his policy at the age of 30 and he makes a regular payment, but come 46th year, the policyholder decides, or for some reason because of the economic condition or otherwise, he willingly or unintentionally is not in a position to pay the premium to this policy. Hence, at this particular point in time, the policy will be deemed lapsed. Of course, a lapsed policy will not have any benefit accrued to it. That means any further benefit or the coverage that the insurance company was providing against the premium that it was collecting will lapse as well. So with this understanding, let's now move to the mortality table itself. And for simplicity, I have picked up this mortality table from the GARP 2020 curriculum itself for FRM Part 1. But please do remember that whatever problem that I'm going to solve out here is equally applicable for FRM Part 1 as well as CFA Level 2 candidate. Now, if you refer to the table, I have just copied the data as it is with certain changes, and the changes are that the column F that we are talking about here, I have marked this column as probability of death within 1 year within bracket unconditional. So this word unconditional is missing in your book. Similarly, column G, I have marked it as conditional. Same is the case with a female as well. You could safely ignore the column H, that is life expectancy, or column L as in life expectancy, because relevant to our exam, our curriculum, these two columns are basically not required whatsoever. Suffice to say, for anybody's academic interest, that these are basically complex summation of the expected life given somebody has survived a certain age. For example, if somebody has survived up until 33 years, it is expected that he's going to live for another 45 years. So somebody has survived up until 50th year, it is expected that he would survive for another almost 30 odd years. That's all it means. It has really got nothing to do as far as our premium calculation and a claims outflow calculation is concerned. Okay, so let's boil down to this conditionality on the on the independence part of it. Say, for example, if we are taking the example of, let's say, the policy holder or somebody who has just initiated a policy, or we are just referring to the mortality table. So a 30-year-old person has a probability that he has survived up until the age 30, otherwise healthy, is 97.52%. Okay, and the probability that he may die within the next 1 year is 0.1498, or almost roughly speaking 0.15%. Okay, so given these two figures, can we find out the probability of survival of this particular person, given that he has survived up until year 30? Yes, we could do so. So the way that we do is that we let me just a little bit do it for you. So the way we do it is that probability that the person will survive a, up until the year 31, that is between one more year, which is between year 30 and 31, is the probability that the person has survived up until year 30 into 1 minus probability of death between 30th and 31st year. Okay, so if we do this math, so this becomes, we know this is 0.9752 as has been given, into 1 minus 0.001498. If you do this math, this comes out to be 97.37%, or in decimal terms 0.9737, exactly the same thing which is appearing out here. Okay, so there are a couple of things that we understood out here. First is that the survival probability at any given point in time is conditional, always conditional to what? Because somebody may only die once in a lifetime, so it is conditional that up until then he has survived the previous years. Okay, however, when it comes to the probability of death, these figures are quite random in nature. They might have been collected by survey over a period of time. Well, that's not where really our concern. All we know that these data are unconditional in nature. Okay, so we make use of this unconditional data here in column F along with the conditional data in column G to find out one more year of survival, given the person has survived up until that particular year. So for example, I'll work it out once again. So what is the probability that the person may survive up until the 51st year? That is the conditional probability that the person has survived up until 50th year minus 1 minus probability of death. This is the unconditional death, of course, that is existing between the year 50 and 51st for that person. So if we do this math, the conditional probability that the person survives up until the 50th year is 0.92913 into 1 minus 0.004987. So if you do this math, this will come to be 0.924419. Remember, in this whole exercise, we are just interested in calculating one more year of survival. That's important out here. Okay, so the next worksheet is just that. We have taken, all that we talked about. So this is the calculation part, which I am showing you. So you can see, refer to the formula bar. It talks about the probability that the person survives for one more year. Now, there is one interesting thing. Why are we talking about all of this? So for our reference, let's take the example of an insurance company. The insurance company has now been approached by a healthy 30-year-old man, and that particular person wants to insure himself for the next 3 years, for which he wants to take out a policy. So for him, of course, the insurance company needs to understand that what is the break-even premium. The break-even premium is basically nothing but wherein we try to understand that the present value of the expected total claim outflow or payout, claim outflow or payout is equal to present value of total premium pay or pay in, right? So this becomes our break even premium. But it is only fair that this is how the minimum premium for the insurance policy must be priced, right? Great. So if we have survived, if we have understood up until here, so here is now a little bit twist to this whole thing. So if you see that, if you, I'm scrolling through the rows out here. So the probability that he survives, which is basically the calculation that we just talked about. Now, the important thing out here is what happens if he takes out the policy in year 30 for the next 3 years. So 1, 2, 3, for the next 3 years he wants to take out the policy. So interestingly, the insurance company first must map what is the probability that he may actually die within the next 3 years. So he may die within the next 3 years is again a function that he will survive, he would have survived up until then, multiplied by the unconditional probability of death the following year, right? So see here how I worked it out. Refer to the column number N. So the first year of conditional death is equal to the first year of the unconditional death here as well. So which both are is equal to 0.001498. Remember, we're talking about a 30-year-old person. Had it been a 50-year-old person, then the base year would have the same statistics, that is the conditional as well as the unconditional death will be deemed as 0.004987. See where my cursor is hovering down. But once he has taken out the policy, now it becomes conditional. Once the policy is being taken out, thereafter the probability of death becomes a conditional thing as far as the insurance company is concerned, right? So what is the logic? The logic is that the first year we know that there is an unconditional probability of death. The second year, obviously, he has to, if he survived the first year, then only he can die the second year. So the conditional probability of death is the condition that he has survived the last year multiplied by the unconditional probability of death the year after that. So see how I have calculated. Just follow the syntax bar. This is exactly what we have been preaching, what we have practiced in the last worksheet as well. So the first year it is 0.1498%. The second year it is 1 minus 0.1498% multiplied by 0.1536%, or in decimal term 1 minus 0.001498 multiplied by 0.001536. I've just taken this multiplicative factor, right? So this is the conditional probability of dying in year 2. Similarly, the conditional probability of dying in year 3 is that he would have survived the first year, the second year, and now the unconditional probability that he may die in the third year. So just again follow the formula bar. It is 1 minus N8 into 1 minus D9 into D10. Similarly, fourth year, it is 1 minus D8, 1 minus D9, 1 minus D10 into D11. Now, one might, you might be wondering out here that why do I need to make it such a complex calculation? Okay, the reason being, understand this, that between 30th year and the 33rd year, if he takes out the policy for 3 years, so the insurance company needs to know that death may occur at any given point in time. In any of the years, death may occur, right? It can occur here, it can occur here, it can occur here, at any time. In fact, it can occur any time in between 30th and 33rd year, right? Now, in order to price the policy, the insurance company first must understand what is the cost part of it. And the cost is basically the sum of the total expected payoff. Okay, what is the meaning of this expected payoff? Well, this expected payoff is nothing but the probability adjusted payoff. And probability adjusted payoff of what? Death. Probability adjusted because you may only die once. Hence, we have to find out what is the expected payoff, or what is the expected payout rather, should there be an eventuality in the first year. So we find out that probability. Second year, well, he would have had to survive the first year in order to die in the second year. Similarly, the third year and the year after that. So when we find out all of that, this is the entire duration of the policy as has been requested by the policyholder. So first we find out the cost, and the only way to find out the cost is to sum of the all expected payoff, which is probability adjusted. Once you have done that, second, we will then try to find out what is the premium that should be attached to this particular cost, right? That is how the entire thing happens. Okay, so if you've got a hang of this, let's now take out a particular problem. And I have now, first I will go to the cost part, which is from the insurance company's perspective, which is basically the claims outflow. So here we have taken 4 examples. Let's understand these 4 examples, starting with the year 30th. So the person has taken out the first year policy when he was of the age of 30. The probability, the unconditional probability that he may actually die the year after that, that is within the next 1 year he may die, is 0.001498. If suppose he has taken out a policy for a $10 million, so the expected payoff as far as the insurance company is concerned is nothing but this $10 million multiplied by this unconditional probability of death. So that is exactly what I've done here, and this comes out to be 14,980, right? But this policy has been taken out for 3 years, so we need to consider all the 3 years in succession. So the expected payoff in the form of claim from the insurance companies, the first year is 14,980. What is the second year? Well, second year, as we say, that you have to first survive through the first year and the second, and then only you can talk about the eventuality in year 2. So I have linked this worksheet. So just go back to worksheet N9 into cash flow G4. Worksheet N9 is basically this particular year, and as you can see, it is 1 minus N8 into D9, which we had just talked about. That is the probability that he survives, that is 1 minus 98 into the unconditional probability of dying in year 2. So that is what this figure is coming out to be, multiplied by the sum assured. So the sum assured is 10 million in year 2 as well. It is going to remain 10 million all through the policy year. So this becomes the expected payoff should there be an eventuality in year 3. Similarly, if you go to the third year, the probability of payoff is, again, it is N10, worksheet N10 into cash flow into N10. So let's go to this N10. N10 is nothing but this particular thing, which is 1 minus N8 into 1 minus D9 into D10. Of course, this is the conditional probability of survival for the first year, the second year, and then there be a death in the third year, right? So this is the third year probability of death. Okay, so these are the expected payoff for a 3-year term policy for a healthy 30-year-old male, right? Similarly, we did the exercise for the base year. Now, this 30th year is also called as the base year. Similarly, we did the exercise for a person who is 31-year-old. So the 31-year-old has a probability of dying in the next year is 0.001536, and the expected payoff as far as the insurance company is concerned is $15,360 in the first year, $15,736 in the second year. Watch this syntax. I want you to pay special attention to this. Pause the video as many times as you want, but do not miss the formula. That is important. And in the third year, the payout is again happens to be this one. Again, watch the syntax. I have now directly, instead of connecting the two sheets, I have now directly calculated from the probability table itself. I've directly calculated the payoffs. Okay, and it's very easy. 1 minus probability of death in the first year multiplied by the 1 minus probability of death in the second year multiplied by the unconditional probability of death in the third year. Okay, multiplied by the sum assured, which is $10 million each year. Okay, so that's the whole thing. So we have got the cash flows out here. Similarly, the exercise has been done for a 70-year-old person. If he wants to take out a policy for the next 3 years, how it is going to look like? Well, it is going to look like this. So these are the claims outflow as far as the insurance company is concerned, but obvious that this claims outflow is going to be much higher than the 70-year-old person, because we know it for a fact that the 70-year-old person will have lesser degree of survival probability for the next 3 years as compared to a 30-year-old person. So similarly, we have done it for a 71-year-old person as well. And again, as before, I would urge all of you to pause the video, go through the syntax and the formulas that are appearing on your screen, and convince yourself how it has been done. All right, so we've got all these cash flows out here. Now there is a big question, and what is that question? So the question is that, all right, so the cash flows have been mapped. So I'm just mapping the first year's cash flow here as they are appearing. So 30th year, obviously the year which is the base year or the 0th year, there is no cash flow happening. And this is the first year, this is the second year, and this is the third year. Okay, so what are the cash flows that we have come out to be? Well, the cash flows happens to be just mapping it out. It is 14,980 in the first year. The second year, the likely cash flow is 15,337, and last year is 15,712. Great. All right, so these are the expected payoff or the probability adjusted cost to the insurance companies. Now, if this be the case, how do we sum it all up? How do we actually arrive at the total corpus that the insurance company might have to actually keep aside for this policyholder? Well, we have to find a way of discounting them back. Good enough. So where do we discount them? Well, now here is a paradox to this whole thing. We are assuming, when we do this exercise, we are inadvertently we are assuming that the person is actually dying at the end of the first year itself, right? When we see so, it's dying at the end of the first year itself. Similarly, he dies at the end of the second year, or he dies at the end of the third year. Well, we cannot really fix the day a person would actually die. That only God would know. So, but for our brevity's sake, we need to make some sort of assumption. So we say that the best guess estimate is that we take half of the year every year for the death to happen. So the first year, well, this eventuality can actually take in place in the midway between the 0th year and the first year. Similarly, between first year and the second year midway, and again midway between second and third year. All right, so if we have done so, that means that for us the discounting thing becomes that much more easier and acceptable, instead of actually boiling it down, and instead of actually placing it up until the last year of the day, as if by magic he is going to only die on the 365th day of the year. Well, that does not happen, we know that. All right, so we have got that when we have to take these things into consideration. So the first year it is happened to be 0.5 year, the second year it is going to be 1.5 year, and the third year it is going to be 2.5 year. Okay, so the next thing is that if we have to find out the present value of this entire cash flow, we also need one more thing, and that is the discount factor. So which discount factor should we take? Well, we should take the discount factor as the risk-free rate itself. Now, one might argue that why should we take the risk-free rate as the discount factor? Well, as simple, because the risk-free rate actually provides you the utmost certainty of the death actually happening, because that's the worst case that the insurance company must face. So, and because it's this risk-free rate, if we put that risk-free rate in the denominator, the numerator will be the maximum that we can think of. And that's the worst outcome that the insurance company must be prepared for. All right. So we discount this 14,980 by 14,980 divided by the risk-free rate. For our purpose, we have assumed the risk-free rate to be 6% out here. So this is divided by 1 plus 6%. For 0.5 year, and the second becomes 15,337 divided by 1 plus 6% to the power 1.5, and the third is 15,712 divided by 1 plus 6% to the power 2.5. Right, so these are my cash flows. Now the rest of the things is very easy. All that we do is to add all of them. And exactly this is what we have done. So what we have done, that if we have assumed now first what we did is that we have, because of this mid-year assumption, we discounted them suitably by 6%. So this 14,980, if you discount them, this particular thing, this comes to be 14,550. For the immediate death assumption for the second year, this amount becomes 14,053, and the third year this becomes 13,582. So sum total of that is 42,186. 42,106, exactly this figure. Similarly, I have done it for the 31-year-old person. Okay, and that figure comes out to be 43,264 as has been declared. Okay, so with this, for a 3-year policy, we know what is the worst case if expected payout that the insurance company should be prepared for a 30-year-old person if he takes out a policy, or a 31-year-old person if he takes out a policy. The similar treatment has been done for a person of 70-year-old age and 71-year-old age. So this portion is basically the cost part, right? Now let's get into the premium calculation. All right. So in premium calculation, what happens? We would not know what is the premium. We have to find out that. That's the task. But we know a couple of things. If this is the base year, and we are really talking about a 3-year policy, that means that the insurance, and that is the law of insurance, that the premium must be paid beforehand at the start of the year itself. And that is the law of insurance, because that enables the insurance company to undertake the risk. So that means he will pay the first premium here, the second premium he will pay here, and the third premium he will pay here. Okay. And these arrows actually indicate the policy coverage after once the premium has been paid. So he pays on the 0th day the premium. The second premium he pays on the end of the first year itself, or the beginning day of the second year itself. And the third premium he pays at the end of the second year or the beginning of the third year itself. Okay, so these are the 3 payment period that he does. Now, so all that we know, that we know the premium payment date. Now there is one more catch to this whole thing, and that is he would only pay premium if he is alive. Remember, he has to be alive in order to pay the premium. The insurance company would want the person to be alive, because it works for the insurance company. The insurance company can actually pocket the premium, and in case of a term life insurance, will not have to pay anything if the person is actually alive at the end of the policy term. So in order to understand that, in order to price this, the one more aspect that remains is to understand, hey, what is the probability that A, he's going to make the premium, and B, hey, what is the probability that he is alive, he survives the first year? Because only if he survives, he will make the premium. Of course, making of premium is also a function of willingness to continue with the policy and the economic status of the person. If the person is not willing to make the premium for the next year, well, automatically the policy lapses, as we have discussed beforehand. All right. So the first year when he actually makes the premium, the probability of survival is always 1. Why is it so? Simple. He is alive. That is why he is taking out the policy, right? And he's making the premium beforehand, right? So the first year, the probability is always 1 that he's going to make the premium. What about the second year? Well, second year, it will depend whether he's alive or not. So how do we know that whether he's alive or not? Simple. We again refer back to the the mortality table and find out. So I've just worked out the exercise, the same exercise as for our 30-year-old policy holder. The first year, he makes the policy payment, the probability is 1. The second year, he makes the payment, the probability is 1 into, where 1 is basically the probability of survival for the first year, and 1 into 1 minus F8. F8 is what? The unconditional probability that he may die. Simple. So obviously he needs to be alive in order to make the payment. So we find out that, so that probability happens to be 0.9958502. I don't think I have to go into any more details, because by now it should be clear as daylight. Similarly, the third year, he makes the payment subject to his probability, subject to he being alive, is probability of survival of the first year multiplied by the probability of the survival of the second year. Of course, that's a conditional probability of survival multiplied by the conditional probability of survival in the third year itself. So again, follow the syntax, follow the formula bar, and things would be much easier. So that comes out to be 0.996968. All right, so we've got a couple of things. One is that we have got the probability of he being alive for the next 3 years in order to make the payment. And B, we are assuming that he is willing to make the payment. Because he's not willing to make the payment, well, simple, his policy would lapse. All right, and how much premium he's making? Well, that's exactly what we want to find out. So we depict that as X. So what is the expected pay-in the insurance company can expect in from the form of premium? Well, that is X into 1 for the first year, X into 0.998502. Obviously, this is probability adjusted, and again X into 0.99698. Again, which is nothing but probability adjusted. Watch how I have actually depicted that, right? This is the premium. So he's paying, for example, if the 30-year-old person is paying X premium each year, so these are the premium that he will be making payment of. Now, what else is required? Well, one more thing that is required is that how do we exactly convert them into present value? Okay, how do we convert them into present value? So all that we need to know is that, well, we need the discounting factor, and yeah, that's it. So the first year, the discounting factor is same because it is year 0. So his present value of making payment is X into 1, which is X itself. The second year, the discounted present value is nothing but X into 0.99502 discounted by 1 plus 6%. Remember, 1 plus 6% because 6% is the discount rate that we have assumed, and that to the power 1, right? And similarly, the year after that, it is going to be X into 0.996968 discounted by 1 plus 6% to the power 2, right? This is exactly how I have depicted. So if you add all of them, you will get the present value of the total premium payment or the pay-in from the insurance company's perspective that they can expect. And this comes out to be 2.83x. 2.83x. All right. So I have also worked it out for the 31-year-old person, and for him, that also the amount comes out to be roughly 2.83y. And that's perfectly fine because it's just a 1-year gap that we are talking about. And really speaking, we're dealing with 4, 5, 6 decimal places. So numerically, they would almost be same. All right. So how do we price that? Well, we use the basic logic that the present value of the cost in terms, which is basically nothing but the payout in the form of claim, must equal the PV of the total, of course, the total PV of premium receipt, which is pay in. Remember, we are talking from the insurance company's or IC's perspective, right? So these two must be equal in order to arrive at the break-even premium or the fair value premium or the minimum premium. Okay, so if you equate that, then we have gotten the premium for the 10 million sum assured. How do we do that? Well, that's simple. That's pretty simple. So we have the costs out here, which we have already mapped out. For example, for a 30-year-old person, the total PV present value of the payoff comes out to be 42,186, whereas the present value of the premium payment happens to be 2.83x. So if we equate these two, we get the value of X as 14,907. The similar exercise for a 31-year-old person will, against the total payoff of $43,264, the premium calculation happens to be premium calculation happens to be 15,288. Watch how this has differed because of 1 year, although the sum assured or the policy amount remains 10 million for both these persons. So that is how this break-even premium has been calculated. So I hope that this example has been pretty extensive enough for you to understand, and I don't think that it could have been depicted any simpler than what I have endeavored to do here. There's only one more thing that remains, and that's fairly easy. If you've understood the relationship, that how an unconditional death probability is being used to find out the conditional survival. Again, the conditional survival leads to finding out a series of premium payment, and again, a conditional survival can also be attached to 1 year unconditional death as well. So we have, we have attached all those formulas. We have, and tied them up, and we have logically explained how the claims outflow happens from the insurance company's perspective in the form of expected payoff, vis-a-vis how to price that particular product. So there's only one thing remains in this whole exercise is, you may face a question in your exam like, hey, what is the probability that a person may actually survive 70 years, given that he is 30-year-old now. Now, the person has survived up to 30 years, should sit in the denominator, and the person that he survives up until 70 years will sit up the numerator. It is as simple as that. If you ask me why, well, we know that these values that we are talking about, they are interrelated because of these calculations that we have already done. And this is a cumulative probability. Of course, the 30-year-old person will have a much higher probability of survival than a 70-year-old person. So all that it happens is that, we just simply divide one by the another. The survival probability of a 70-year-old person has been given at 0.73427, and the 30-year survival is 0.9752. Remember always that the survival probability of a 70-year-old person is always conditional. The person has actually survived up until the age of 30. So it's given he has survived up until the age of 30. That's more important, and that's priority in base formula as well. So that goes into the denominator, which is obviously more than the person survival probability in the 70th year. So if you do this math, I'll just do it for you. It comes to be 0.73427 divided by 0.9752. So this comes to be 75.29%. So that means the person who has survived up until the age of 30 and otherwise is in sound health, retains a probability of 75.29% that he would see the 70th year. So that's all, folks, from my end. I hope that I have been able to discuss and detail the entire framework of how the mortality table is being put to use in order to calculate the expected claims outflow from the insurance company's perspective, and how do they actually price an insurance product in terms of the premium calculation. Should any one of you require this particular worksheet, which I would be more than glad to share it with you, write to me at my email ID. I'm sure you would have it. In case you do not have, it's new avatar, newatar190 @gmail.com, or analystmaster@outlook.com, and I would be more than happy to share this Excel sheet with you for you to practice. That's more important. Up until then, thank you. Bye bye. Good night.